I got a 15-second delay, but I know you can all hear me. I know you can all see me. So I want to reach out and wish, as Tony Rago's preempted me, but I want to reach out and wish you all happy holidays and a safe Thanksgiving. And if you're flying, you have my sympathy, because flying over Christmas and flying over Thanksgiving in Chicago O'Hare, which is the second busiest airport in the nation next to Atlanta Hartsfield, is hell. I'm staying home and I'm happier for it. Now, with that said, let me give you my normal kickoff in the morning here, as I normally do. Good morning and welcome to the second hour of TheoTRADE. You know me, I am Professor Jeffrey Bierman. I am broadcasting you live from Chicago, and today is Wednesday. It is November 27th. It is 2024. Good morning, TheoTRADE members. Great to see the old usual faces. I'm waiting out there. I know Jamesy's out there. Shirley Trains is here all the time. Hashpipe. You guys are regulars. I feel like it's like Cheers at Theo. We're at a bar and we're like sharing and kicking around anecdotes. So good to see you. Happy holidays and happy Thanksgiving. Now, without further ado, okay, I'm gonna present you. I have my slide up here for what I intend to do today. My coaching session today. Those of you who know me, when you come here, okay, Tony is what I call consistently consistent. He is lather, rinse, repeat a billion times over. He just does the same thing over and over again, doesn't veer, has a system, and prints money. Fantastic. But we're not all created the same. We all do different things here. So you have a smorgasbord. You have your variety of pick of what you want to learn and strategize. For me, I am focused around algorithms. That's what I believe runs the market, and my trading system is based around it. I use technical indicators, formulaic. I use classical technical indicators like patterns and drawing tools. But today, we're going to rotate. Again, I'm consistently inconsistent compared to Tony. I don't stay on one topic for that long, usually 1 to 3 days, and then I rotate and shift to the next topic. I don't want to bore, I want to entertain, I want to educate. I always want to provide an edge, something you can take away every time you come to Theo. Some things you've heard before, some things you haven't heard before. This is a session where you've never heard any of this. None of you know pretty much any of this. You might know 5%, but today's coaching session falls under the volatility category. You can see it on your screen. Category volatility. In my personal archive, you go to Theo, you click on, the library, you go to the archives, you see there's many different archives. I got one personal, then there's one gigantic Theo archive. I'm in both. Those are the 3-hour ones. These are the 1-hour ones. So I've got trend, I got momentum. You're around the horn, baby. It's been a while. It's been 2 months since I've spent any time talking about volatility. So now is the time to talk about volatility. Why? People, I've been doing this 36 years, and I see things I love and I see things I hate. What I see now, I absolutely hate, and volatility's coming. You don't think it's coming. Me, Don, Brandon, Blake, Corey, we all know it's coming. We just can't time the minute or the hour. We cannot do it. So what I'm doing is I'm preempting the vol, because it's going to come. And if it ain't coming next week, it's coming the week after. If it ain't coming the week after, it's coming right around the New Year's. Things are going to change. Okay, you're in that end of the year window dressing, like closing window, and you feel the panic. You feel it. It's palpable. You see the rotations, and yet the VIX is contained. I'm going to address that today in my commentary. But today's coaching session is called "Prepare for Takeoff: Esoteric Facts and Rules." Now you're going to think that this is, oh, he's just going to come at us with graphics. I am, and he's just going to talk about things that are. And the word esoteric means not obvious, under the radar. And you're going to think like, there's no value. There's more value here than I've ever presented at any time that I've been on Theo in 8 years. Okay, these are rules and facts about volatility that's going to get you thinking about how to strategize while you're trading. So for those of you who are position traders, I will address it. For those of you who are intraday traders with Rago and Rosenblum, I will address that as well. I'm going to attack it from all sides. I'm not here to argue against it. I'm not here to embolden it. I'm not here to defend it. I'm here to talk about traders' rules that have been established for 50, 60, 70, 100 years. We're going to go through a lot of facts and rules around volatility. If you underestimate volatility, it can cost you. To me, more money is lost from two things: underestimating momentum and underestimating impact of volatility. Momentum isn't vol. They're two separate things. Vol is a shock to the system. Momentum is a death by 1,000 cuts. So either or, this is a good time for you to dial into this. We're going to go only through 3 of the bullet points today. I'm not going to reach all bullet points. It's not possible. I can't jam it down your throats, and I don't want to jam it down your throats. There's no point. So it'll take at the minimum 2 days, max 3. Today, we're going to talk about 16 unbelievable facts about market volatility. It'll blow your mind. It'll make you change the way you trade a lot of products. The second is we're going to talk about stock market halts. And the third is we're going to talk about historical volatility patterns in US trading hours. Okay. Things that you think you knew and you're like, I didn't know that. And it will change the way you operate. Okay. Intraday trading. That's what I'm meant to do, to make you think twice about placing trades at certain hours of the day, because the market does work in what's called chronological trading patterns. Believe it or not, during the day. It's been time tested. Now, let me get to today's market catalysts. The title of today's market catalyst, and forgive me for my puns, Kaufman hates it. So the reason why I do it is to piss off Don. If there's any reason why I do it, it's to piss off Kaufman. Okay, it's called Thanksgiving Technology Trimmings. You like that? I got the word trimmings in there as if like you're at the table and you're eating cranberry sauce and the stuffings, the trimmings. This type of trimmings ain't palatable. It's one where you want to vomit up the trimmings. It's trimmings as in curtailing positions and selling pressure on the market. Now, the market right now is down 22 points. It's not going to go down much more than that. It can't go down that much more than that because there's not enough other ancillary supporting cast to drop it lower. And I'll get to it. You're in the middle of seasonality. You're at the Black Friday climax, okay? Which simply means you've been rallying up every day, every friggin' day since the bottom in August. You're up 3.5 months almost every day except for 2 or 3 days. That's it. Now you're at the point where you're at the crescendo. You're at the climax of Black Friday. And ironically or not so ironically, because I think it's by design and it's manipulated and rigged, that we're at a double top. You're at the double top, which I'll show you. You're also still in that year-end performance gaming. It's still in play, which means the market's not ready to roll over and die. Stop. They're still rotating to financials. They're still rotating to retail. They're still rotating the cyclicals. That alone is going to keep the market from Atlas holding up and shrugging. It's going to hold the market up. So tech is the cement kite. Everything else is propping it up. Okay? You're also in pre-Thanksgiving thin volume. Now, you might look at that and say that's constructive. I could argue on the other side of that. Thin volume means there ain't a lot of buyers underneath this market for tech, which means it could bleed to death. But at the same time, the thin volume is walking up the performance gamers who are chasing 52-week highs like Walmart and Costco. So one's offsetting the other. But with thin volume, you know one thing. We're not likely to go any higher. It's not going to happen. But we're not likely to go any lower either. You have to have accessible, substantial overflows of volume. The trading desks are thinned out. So expect today to be a pretty much like, down 22, and we sit there all day. That's my expectation. Now, let me get into the rotations in just a minute. So here is the S&P 500 as I see it in my primary model. I got a lot of models. Got a lot of them. It's my favorite one, okay? All I did was substitute the Stoke, which is overbought, with money flow. Again, the bank robber. I keep always telling you, Willie Sutton, why rob banks? Because that's where the money is. You just need to be aware of what's going on here. You're thinking the market's going to crash. No, it's not. It's not going to crash because money continues to flow in. As long as money continues to flow in, that product can't move. It's like stick a nail in its foot. It won't. You're wrong. You have to have distribution to make that happen. What you're getting is it's a pullback. Yeah, money's still going in. Don't be fooled. To me, this is just what I call consolidation at a double top. Now, ironically, or not so ironically, Tom DeMark called the top of the market 3 months ago. You know what his number was? 6042.5. DeMark was within 3 points of calling the market top for the entire year and for the next year. That's what he says. Interesting. We'll see as it plays out. But I digress. You're on a red candle today. Big deal. The advanced decline is 2-to-1. It's 1,800 up and 700 down. You're not getting the market down. Stop, bears. Stop. You can't get it down. You got to change the advanced decline. More stocks have to fall. And if you're going to tell me, but it's overweight in tech, doesn't matter. Tech's getting slammed and the market ain't moving. What's your point? You can't have one sector drop the market. You have to have a preponderance, a concentration of all sectors. You need tech and financials and retail, which makes up 75% of the index drop. Are you getting that? You're not. Financials are holding strong. Retail is up. That's offsetting the damage. Unless the bulls throw in the towel and sell retail and financials, not going to happen. It won't. So tech is taking the market down. But my issue lies in the slopes. And I keep telling you, the slope is the most important indicator I can ever teach you. The slope is going to make you rich or poor. In any indicator, period. The slope is the most important thing ever. What's the slope doing? It's mildly down. That's why the market's down. But it's only mildly down. It ain't 30 or 40 degrees. It's barely clipping. Oh, goodness gracious. It's down 5, 10 degrees. That's not going to drop a market. You got to drop it like that, to blow that out. Is that what you see? Then stop projecting and romanticizing. It's going to kill you. Trade what you see. Red candle, selling pressure. Mild bearish divergence, but nothing serious. Flat MACD. A flat MACD is not a sell. Not. It's actually a buy because it's above the signal line and it's above the zero line. So until that MACD lip curls and changes its slope, I'm not declaring any victory for the bears. Zero. Last but not least, I need to see distribution. Every time the market drops, more money comes in. Drops, money comes in. Goes up, money goes in. They're just adding on the way up. They're adding on the way down. You got to scare the crap out of the bulls and make them want to puke up everything. This, to me, is just a consolidation move to digest a flag formation. Nothing more, nothing less. But I digress. There is something afoot. The rotations are interesting. Clearly, you can see money managers are lemmings. You are. All of you are. You just follow what everybody else does. But of course, and you move furtively in big chunks. So check this out. Computer stocks short-circuited today. Well, why is that? Here's Dell. Here's Johnny. Okay, Dell disappoints. Good earnings, but the guidance pissed off the market. Hewlett-Packard, good earnings. Guidance really pissed off the market. Did not like the guidance going forward. Translation, computer sales are slowing to a crawl. The economy's slowing down, but the stock market's like, no, it's not. Nothing to see here. Really? As soon as we play catch down to like 5,000, what are people going to say? I should have sold. You should always sell when it's up. You should never sell when it's down. You should sell when it's on its way up. It's the whole point. So now you've got computer stocks getting short-circuited. Then you have software stocks. They're in a slump. So all of a sudden, Autodesk comes out. ADSK. Autodesk pisses off the market. They delivered good numbers, but they didn't like the guidance. Listen, I can't figure. I don't trade around earnings. Jimmy Crackhorn and I don't care. All I'm telling you is it's restraining the market. It's what I call the software slump. And then on top of that, CrowdStrike comes out. It wasn't that bad. It wasn't that bad. But apparently the market didn't like CrowdStrike's conference call. They didn't like it. Okay. Then again, the stock had already rolled up 147 points from its bottom. And the numbers were pretty good. They fought off their problem. Their problem was, they had that that airline problem. They overcame, delivered 93 cents. But they still said the impact is going to weigh on them, and they haven't worked it off yet. So here you have still, it's an algo channel. but it's a software stock and it's cybersecurity. So you got the software slump. Then you throw on top of that for the technology trimmings. You got the chip dip. You like that? The pun, get everybody chip dips like Doritos. Like that? Listen, people, I put a lot of thought into it this morning. Give me some love. So AMAT, breaking down again. It's bottomless. Then you have Advanced Micro, breaking down again. It's bottomless. If there's anything I've learned about the market in this 36 years, you cannot fight algos, and money managers always panic sell at the bottom. Look at them. I got to get out. Oh, but you loved it at 187, didn't you? I want to get out now. I'm not telling you to buy it. I'm not buying this at all. It's in an algorithmic channel. I won't touch this thing. But this is the type of stuff that prohibits that index from going higher. The chips themselves do not look good. Even ASML can't catch a bid. It's down yet again. It's like what I call a death by 1,000 cuts, a slow bleed. If you enroll in my mastermind mentorship, the Genesis Cog, I will teach you how to read algorithmic channels so you don't ever fall prey to buying something like this. That is what I do best. Next on the list here. Oh, by the way, Avago still can't catch a bid. Look at AVGO. I can't catch a bid. So here's AVGO. Okay. Is it down again? Down $6. Breaking down. That's a technical breakdown. Loss of support. 99 Avago. What's wrong with it? I don't know. I don't care. Apparently, the valuations at 136 are making people nervous. Really? And Walmart's at 50 times earnings doesn't? Go figure. What I've learned about money managers is this is how they think. On the way up, that means nothing. On the way down, it means everything. Of course it does. Money managers never talk about valuation unless it's down. On the way up, it's valuationless. So that's something I've always learned in the business. Value means nothing. It's just going up, so I'll chase it. Last is mega restraint. So the mega stocks, the trillion-dollar companies, okay, they are restraining the market from going higher. You got Mr. Softy, down mildly, not a big deal. You got Meta, down mildly, not a big deal. It's what I call a restraint. It's not a technical breakdown, Theo. Stop. It's not a technical breakdown. It's a restraining order. They're just being restrained. Still, but the charts are still bullish. They're flag formations. They're just being pulled back today because they are sources of cash for uses of cash to buy retail. The last puppy that's going down here, you got Tesla, down 7. It's just who cares? 7 is nothing. Get me down 40 and you get my attention. The last one is Apple. Apple just grinds. I'm going to grind. Apple just grinds. It's down 48 cents. That's nothing to see here. It's just a restraining order on the market, the megas. So with technology trimmings, let's pull down the tide. No, sorry. There goes Walmart. There goes Costco, new high. Whatever's up. Is Deere up again? There goes Deere. Cat, let's go Cat. These money managers, they're so obvious what they do. Get me out of tech. Got money. What do I do with it? Buy the parabolic 52-week highs. That's what they do. They're just moving money back and forth like Don says. That's not a recipe to make the market go lower. It won't work. You have to break down every sector or almost all of them, or at least the two largest. And it ain't happening. Goldman, nah. JP Morgan, not happening, people. It's not, this isn't that day. Stop. It's not happening today. You got to get the financials out. And that's a flag formation. Look, flag formation. Not going to go down. It's not going to happen. So if we go down 40 today, it'll bounce at the end of the day. Pardon me for a second. Come on, buddy. There goes Snowy. Snowy is the world's fastest, biggest cat. She's as sweet as pie. And when she needs to go, you got to let her go or she'll just tear the door down. All right. Without further ado, we're going to leave this behind. We're going to leave technicals behind today. And we're going to go into, by the way, that was Thanksgiving technology trimmings was the theme today. And we're going to go into my program today, which is prepare for takeoff, esoteric volatility facts and rules. Again, I'm going to point this out. I don't care if you're an intraday trader, position, or investor. All of these will address every single strategy and timing factor. I've got some really under the radar esoteric, weird, but valid facts about how traders and investors trade at certain hours of the day, certain days of the week, certain months of the year, and it runs the gamut. I've got one more bullet point, which I didn't get on, but I'll put it on. It's going to take a minimum of 2 days, max 3. But again, I'm never in a hurry to jam it down your throat. So what's the first thing I'm going to address today? It's called 16 unbelievable facts about market volatility. When I read these, I was like, you have got to be kidding me, because what I thought I know, I didn't know. Like, I'm learning on the fly, and I'm the senior here. I actually turned 60 on January 8th, and I have a birthday in San Francisco at my sister's place on the 3rd, which is a Friday night. So I'm going to fly on New Year's Eve. That's going to be fun out of Chicago. It'll probably be hopefully an empty airport, and hopefully it won't snow, because right now it's 30 degrees in Chicago tomorrow, but we'll get there. But in the meantime, I am the senior here. I'm going to get my AARP card in 2 years, and I'm actually excited about it. Getting old's not that bad if you take good care of yourself and you have good financial wherewithal and good genes. And I was lucky to have both. So let me get into the 16 unbelievable facts about the market, and I'll see if I can get through them today, one by one, and then we'll address market halts. So it'll probably take about 3 days. So here's some market-related stats that a fellow technician compiled. He's also a portfolio manager. It's killer stuff, and I track him. His name is Ben Carlson. The guy's really smart. So first things first, did you know that the period ending in March 2020, and I'll go back there because I can pull it up here. Now, I'm going to pull it back 20 years here, right? March 2020. I got 20, I'll bring up the S&P 500, but this isn't about necessarily that. The period ending March 2020 saw long-term bonds beat the US stock market for the first time in 25 years. A lot of people do not know that the period ending March 2020 up to prior to that time, so from the spring of 1996 through March 2020, long-term bonds returned 8.2% annually versus a return of 8% per year of the S&P. Let me repeat this again, TheoTRADE members. You think you know it all. You don't. Bonds had a higher return over the years 1996 to 2020. 25 years, bonds returned better than stocks, the S&P 500. Did you know that? And they did it with 1/3 the amount of risk. That's the ultimate in price performance ratio managing money. 1/3 the risk with a higher return. So people say, well, what was the return? It was 8.2% annually versus 8% for the S&P. And they did it with 1/3 less volatility. So let me bring to you, if I can, the graphic to support my perspective on this. See if I can get it for you. I have it here. I compiled it. Come on, where are you? I know I put it here somewhere. Okay, so here is, come on, the total return of the Vanguard. Is that the Vanguard index? Now I'm going to go, am I missing it here? I wasn't able to pull it up here. Okay, there's one of the other facts. Well, I'll bring this one to you. Okay, hard to believe. But again, this is an overlap from another factoid. This black chart, that's the S&P, that's the SPY. The one on top is the long-term bond fund. I want you to take a look at this. Look at the return, and it starts actually in 1996, but this one goes from 2000 all the way to 2020. Take a look. What had better returns? Stocks or bonds? You've been misled all your life by the public. CNBC, Bloomberg misleads people all the time. Bonds had a better return. Take a look. Shocking. Now, am I advising you right now to buy bonds? Could be. Kaufman's going for it. I'm going for it. I'm telling you right now, stocks, there's going to be a lost decade at some point. And when stocks get that lost decade, you and I know where money's going. We all know where it's going. We all know it's going to bonds. Everybody in the world knows it's going there. The question is, when are they actually going to jump ship out of the bull market in stocks? We don't know. So I'm looking for the crossover point where the long bond takes off, breaks out of a bear market, then I'm going to load the boat. because I'm already moving in that direction. I've scaled. I'm sitting on more cash now than I ever have. I literally have 50% cash right now. I have very little in the stock market. I'm moving more money to bonds every day, every single week. I'm CDs, bond. I don't want to, with the ride down on this to me is going to be lethal. And if I get 1/3 less risk in the bond market with the same return, I know where I'm going to put my money. I just wanted to make that as a throwdown. Interesting stuff, TheoTRADE members. Okay, I will bring up that graphic one more time. Number two, in its 45 years of existence, the Bloomberg Barclays Aggregate Bond Index has just 3 down years. Did you hear what I said, TheoTRADE members? It's been around 45 years, the Bloomberg Aggregate Bond Index, and it had 3 down years. Here were the down years for the bond index. Negative 2.9%, negative 2.0%, and negative 0.9%. So the worst year was not even a 3% loss on the aggregate bond index on it. So let me bring that back up to you. It had 3 down years, and this is the Vanguard one. It's not quite the bond index for the Barclays, but I do actually have the Barclays. But this is what I wanted to show you in terms of, again, bonds outperforming stocks. Now that I've got that one out of the way, let me bring this to you. Take a look here. This is the Bloomberg Aggregate Bond Index through 2020. Take a look at it. There was a down year, there was a down year, and there was a down year. But outside of those years, okay, these years, which is up to about almost 45 years right there, had 3 down years. So for those of you like, why would I want to be in bonds? Because you don't lose money very often. Because the money compiles and it piles on. Because it's interest, because it's exponential, because it's compound interest that makes you filthy wealthy. That's why. That's the direction I'm going at my age. These are the losing years. Obviously, the bear market and bonds took the life out of it, and you see it get slammed there. That's because we were on a ZERP policy forever. But now that we've kind of reached the worst, this is actually on the way up. The bonds this year are actually going to have a really strong positive year, because at this point, interest rates have come down and bonds have gone up. So the year's not up, but these are the losses over the aggregate bond index calendar returns. Things you should be aware of. Okay, factoid number 3. Long bonds, and I'll bring up the bond futures. Long bonds. You can use the /ZB as the long bond future. And I'll bring up here max available. I'll bring up 20, but we have max available on here. Where's max available? There you go. So here's the ZB. It's as far as I can bring it up. It's been around since 2010 on this platform. Long-term bonds lost more than 50% of their value after inflation from 1950 to 1981. So was there a time when bonds were a curse? There was. This was the opposite of the bond market you saw for the 25 years I just highlighted. Why? It was a time of ridiculously high inflation and constantly rising rates. Well, we all know the Fed's job is what nowadays? Keep the rates to 0. So they're going to cut rates probably not at the end of this year, but beginning next year in the first quarter and the second quarter. That will probably lift bonds. Now, I'm not telling you we're going to come out of the bond bull market yet. I'm not saying that at all. I'm just saying, yes, there was a period when bonds were a curse. They lost 50% of their value. But that's when the Fed had rates way too high and it was hyperinflation. They've learned to control that much better now. So, factoid number 4, Japanese stocks returned 23% over 2 decades in the 1970s and the 1980s. Did any of you know this? Yeah, the Japanese stock market avoided. Yeah, I get it. It had Japanification. Don's profiled it a million times. It went into a stale bear market for 30 years. But there was a time between the 70s and the 80s. For 20 years, Japan had the best market in the world. That would have returned an initial 10,000 invested in the Japanese market in 1970. By the end of 1989, would have returned $610,000. In other words, it would have been up 6,100%. You have to digest that for a little bit. I'm not saying 6,100%. I'm saying 6,100%. So I want to show you this. Ready? This is the Japanese market right here from 1970. This is the Nikkei, all the way to its peak in 1989, 1990. Then it goes into a bear market for how many years? About 30 years. It finally comes out of the bear market at the end of 2013, and then it's been a bull market ever since. So this is the Nikkei 225. You can see right there. This was the best market in the world. So when people tell me, I'm never going to invest in Japan, okay, eat those words. Be careful, famous last words. Investing in Japan's great after it crashes, because once the market takes off and they get in their monetary policy, you look what happens. They got their monetary policy together, bam, it goes from 5,000 to 35,000. That blows away our market. That's a 700% fold return, people. Think about that. Put that one in your pipe and smoke it, okay? Just want to throw that out there. All right, Japanification. Factoid number 5. Holding cash in a savings account would have outperformed the US stock market 1 out of every 3 years in the late 1920s. Now, I know this is outdated, and you're like, why is he bringing this up? I know. Because it's cool stuff to hear this, right? Holding cash savings would have outperformed the US stock market 1 out of every 3 years in the late 1920s. Despite the fact the US stock market has returned close to 10% per year over the last 9 decades, while cash, which is 3-month T-bills, is up around 3% per year at the same time. But there's going to come a time, and I'm going to tell all of you, there's going to come a time where the technicals will turn, the psychology will turn, fundamentals will play catch down to their real values, and we're going to go into a long-term bear market. Could be 20%, 30, 40, who knows? You know what's going to make you money? Cash. Savings will make you money, CDs. So don't dismiss it. Don't poo-poo it. Don't say, stupid. It's not stupid. If you had owned it during the 1920s, you would have come out ahead. You wouldn't have lost any money in the Depression. You actually have made money. So remember, cash savings, it's not a bad thing. That's why I'm sitting on tons of cash in my stock accounts. I got 3 of them. I'm not taking this ride down. We are ridiculously overextended. I can't pick the top. I use the algorithmic model. The algorithms are not ready to blow this out, but when they are, I've got plenty of cash to take advantage. Ask Brandon. Cash is a good thing. It's not a bad thing. Okay, factoid. So let me bring this open to you. Another interesting factoid, if I may, about volatility. Okay, this is the Case-Shiller Real Estate or Real Home Price Index, right? And this is from the 1890s up through the 1970s. I couldn't get more updated than that. But here's the thing. This is a fact. Real housing prices, I think Brandon will find this interesting, and Blake too. Real housing prices in the United States were flat for more than 100 years. Sit down there, like roll this around your head. I bought a house. I'm going to make money. No, you're not. You're not going to make any money. Housing prices were flat for 100 years, from 1870 through 1975. They were virtually flat. Look, you take the time-weighted average of the Case-Shiller Home Price Index, because he did it retroactively. Robert Shiller did with Case. Look what they proved. Your investment is worth nothing. You bought a house for $100,000. Yeah, well, 100 years later, it's still worth $100,000. Be aware of that, okay? Robert Shiller shows housing prices went nowhere for 100 years in the United States. I just thought that was cool stuff. I am sorry. I'm going to buy a house and it always goes up. No, it doesn't. Go to Troon. Go to where Don used to live in Arizona, where my brother lived, Scottsdale. Those houses, you couldn't give them away, okay? They were worth $800,000. Now they're worth $400,000. Not everything goes up ever forever. Supply and demand. Housing is notoriously difficult to calculate actual returns. And who knows how reliable data from the 19th century is on housing. But since 1975, Shiller is willing to admit, and he's come forward and said it, housing prices have doubled on a real basis since 1975. So for 100 years, housing prices are flat. But since 1975, housing prices have gone vertical and they've doubled. Okay. Real estate right now, at this point, might be in a peak stage, it's hard to say, but the demand for housing is still out there. How do I know? Yeah, I can tell by this. This is how I know. That's the demand for housing, the XHB, Spider Home Builders. Is that a bubble? I don't know, maybe. All I can tell you is since 2023, the index is up 100%. That's a bubble. We'll see how long it stands up there for. All right, next on my list of unbelievable facts. Number 7, gold compounded at more than 35% per year from 1970 through January of 1980. A lot of you probably knew this, the old timers. I know Brandon and Blake are really into gold, so this is like a treat for them to bring this like little factoid out. Let me show you the numbers here. That's a total return of more than 1,900% for those 10 years. 1,900%. From January 1980 through today, gold is up more than 150% or a little bit more than 200% per year. So here's what I'm telling you. If you had bought gold in 1980 and held it to today, your average annual return is 2%. And that doesn't include inflation. That's the freaky part about this. So everybody knows me. You all know me. I always have something to pull out of my hat. And I got it for you. It wouldn't be me if I didn't do this for you. Here's the source. Here's gold from 1970 to 1980. It was up 1,900% as an investment. Look at that volatility, baby. Look at it. And you're like, I'm going to buy at 2,500. Look what happened to you. You didn't make your money back until this year. Did you realize that? Roll that around your head for a second. When you buy it, I love the CNBC permables. You can buy at a high, and it's so easy for them to say that in retrospect. Take a timeline or a representative sample base of 50 years and tell me whether you want to buy the stock market right now, today. Yeah, kind of look like that, doesn't it? I would hate to be the last one in the door and go, oh, don't worry, my broker told me it's just a buy and hold strategy. It's so easy when it looks like this and it's gone up for 10 years. But when it reverts to a mean, you realize, like, if I buy now and gold does this from gold and starts way back, you'll have wasted 20 years of your life probably. You might waste 20 or 30 years of your life on equities. So for me, when people say timing doesn't matter, I'm not biting on that crap sandwich. It does matter. There's a time to be in markets and there's a time to be out of markets. There's a time to be in certain asset classes and there's a time to be out, not even short them. If you had bought gold at the peak here, it took you effectively 45 years to recoup your investment. Your investment is zero. Your net annual return is zero. It's still negative because of the time value of money. You lost money. Think about that. So that's gold. Again, I told you I'm doing this for a reason. I'm trying to warn all of you, like, we're in the bubble and everything. Crypto, Ethereum, stocks, gold. It's the bubble and everything, people. When's it going to end? I don't know. I just don't, I'm not timing the top. I just don't want to take the ride down because the ride down means I'm never getting out. I'll hedge it forever and never make my money back. Okay. Don't want it. Too old for it. I'm 60 years old. Next. All right. Next factoid. Number 8. From 1979 to 1999, the US stock market was up nearly 3,000% in total. And that was a pretty good run. I will agree. I will give the market that. From 1979, way over here, wee, all the way to here, this period from here to here, right there. See that? 3,000% return. That's a good return, but it came from a much lower level, not from an elevated level. All right. So let's continue on with this. Number 9 factoid about volatility. From 2000 to 2008, the US stock market was down 28% in total. That was the other side of a pretty good run. So for those of you who are like, listen, I'll get it right. I'll buy right here. And if it backs off, I won't worry. People, the lost decade. This is the lost decade. This is the decade of 2000 to 2009. Net, the total return of the market over that decade, okay, starts at about a negative 28% return. And not a lot of people know that. It's called the lost decade. Annualized return loss was about 4 to 5% annualized. I'm telling you that right now. You don't think that this couldn't repeat here? Will it? I don't know. I've seen this and I've seen that. I've seen this. I've seen this in gold. I've seen this in oil. I just don't want to be a part of it. That's why I don't buy it. Well, don't want it. Will I short it? Not necessarily, because I don't know where the top is, but I know not to chase it either. Annual returns from 1979 to 1999 were almost up 18% per year. That's pretty impressive. From 2000 to 2008, the annualized returns for that 8-year period or 9 years was negative 4%. Told you. So the stock market giveth, taketh away. Make sure you understand when you look at that chart. Just look at it, throw aside, turn off CNBC and Bloomberg. Okay, put everything aside. Look at that chart. Can you take the ride down? Can you go down to 2000? We'll see about that. Factoid number 10. Factoid number 10. Bitcoin. Okay. It would have taken $400 invested in Bitcoin in January 2013 to be worth $1 million today. That's a fact. I don't like these stats, but this one I had to lay out because it's just incredible. And it's here's the thing is, it's mildly annoying because only less than 1% or even 0.5% of the population knew back then even how to invest in Bitcoin. So Bitcoin is technically the best investment over the last decade. Not stocks, not bonds, okay, not oil, not gold. Nuh-uh. Bitcoin's number one on the list. I'll give them credit. Do I want to buy that? No. Next. I hope a lot of you are like taking this all in stride. All right. Corey Rosenblum's in there jabbering away. All right. Factoid number 11. $1 million invested in Enron, remember Enron people, or Lehman Brothers, would be worth $0 today. Why do I bring that up? Just trying to keep you honest. Trying to keep you honest. I want to go and I want to buy that Dash. Get me in there. Get me into Dash. Remember, Enron, Lehman Brothers, they're worthless. Remember not to buy something worthless. Oh, I'm going to go and buy that Neo. You get my point now? And you get Rivian, get me in that Rivian. Okay, I'm going to remind all of you about volatility. You better know what you own. Because when they pull the plug on that app lovin', when they pull the plug on these things and go, did I pay 500 times earnings for a company worth 5%? You'll know when you see something like that. Be careful. That's why I teach fundamentals. I teach it I teach fundamentals in an aggregate portion of the Mastermind Genesis COG class. Worth your while to come and learn. Okay, number 12 factoid. The worst total return for the US stock market ever was a 40% loss. This was from the peak of the market in September 1929, just before the Great Depression. So I want to remind you, it's been nearly 100 years since we had a 40% drop. Do I think that we're going to have a 40% drop? Hell no! But could it happen? Let me look at that chart. Hell yeah. How do I know? Because all I have to do is connect the lower highs and the lower lows. I can connect them here, or I can connect them here. It won't make a difference. Pick your poison, people. Again, the worst year ever we had was down 40+% during the Depression, 1929. Take a look at that chart. And you're telling me we couldn't easily drop from 6,000 to 3,000 and eclipse that? Think again. Things to consider. I'm not telling you it's going to happen. I don't think so. But if I've learned something from my boss, Don Kaufman, Don always tells me, I don't care what you think. He really doesn't. He doesn't care that I think this. But just because I don't think it's going to happen doesn't mean it can't happen. Like I'm standing here going, there's no way that app lovin's going up. No way that's going up from 25 to 300. What the hell do I know? You get my point? All right. Factoid number 13. We're down to 16. Inflation totaled 98% in the 1970s, meaning $1 in 1970 would be worth 48 cents by 1979. Hard to believe. That's an annual run rate of more than 7% per year. So what's the inflation right now? The government says it's 3.2. Really? When was the last time Powell went out to the store and shopped? When was the last time he shopped for groceries? To me, it's more like 10, 20%. I don't believe it. Good. My car premiums, my health premiums. Sorry, Jerome. You know you lie. You spin. You lie all the time. Next, factoid number 15. Inflation was down 19% in the 1930s. That's a truth. This is also known as deflation, which came in at more than 2% per year. So $1 in 1930 would be worth around $1.23 by 1929. That's a bump. But I'm not sure people that back then actually really felt any richer. But the truth of the matter is that 19% deflation bumped up the value of the dollar 29%. Why? Because the time value of money is not arithmetic. It's exponential. It's the compounded interest that drives it. Fact. Factoid number 16. And this is the very last one. Dead honest last one. Okay. The Dow closed at 381 in September of 1929. Like, digest this now, because I got to bring up the Dow. Like, let me bring up the DJIX, the DJI, I think, Dow Jones Industrial Average, right? That was the old one. I think it's like $DJI now. There we go. So in 1929, it closed at a high of September 1929 at 381. Look at it at 44,000, right? It wouldn't cross that mark again until November 1954. So I'm going to repeat this again. This is like the closing one on factoid number 16. It took the market after it peaked in 1929. You ready for this, people? It took 25 years to get back to that high. What would happen if the Dow went down to 15,000, 25,000, 20,000? How long do you think it's going to get back up to the high water mark? Now, I don't know. Obviously, I can't read the tea of the future. But back then, it was only at 381. Now it's at 45,000. The rule of thumb goes like this. You lose 10% off that. You have to make up 11% to hit that number again. You lose, 25% off that number. You have to make a 33% gain to break even to get back to the high water mark. If you lose 50% of the value of that Dow, 50%, and all of a sudden everybody wakes up and goes, all of these formulas and valuation metrics that Wall Street were using, it's all phony. Let's go back to traditional Bierman academic stuff. And you're like, oh my God, it's worth 50% less. And it drops to about 22.5. It will take 100% return just to get back to the high water mark. The question is, do you have the stomach, the tolerance, the age to wait out a 50% decline to make up 100? I don't. I'm just letting you know. So that is what I wanted you to know. Most people more or less gave up on the stock market after it crashed 80% during the Great Depression. If this crashed 50%, my thought process is maybe 20% of the population would sell out and quit, and the others would say, it always comes back. If 10 years go by, my assumption is, and it never gets back, 75% of the people who traded this will never trade this ever again. They'll give up completely. You'll just be worn down by attrition because it's like, but it always went up when I was doing it for 10 years. Well, what if it goes down for 10 years? Are you prepared for that? Nobody is. We'll see. Maybe the short sellers are. But that finishes my 16 unbelievable facts about volatility during historical times. Now, where am I going now? All right, we're going to move to the next one on here. And I don't know how far I'm going to get on this. And I'm not, this might take 4 days. It might take 4 days. I've got 4 days. So I'm going to kick off right now talking about stock market halts. Now, I don't think there's any stock market halt in the impending, like looking through the windshield. I'm not predicting it. I'm not a soothsayer. I'm not saying it's going to happen at all. But I'm saying if it does happen, this is kind of what it looks like. So let's talk about stock market halts and why stock market halts occur. So the question is, people want to ask, Okay, and I'll throw this down. What the hell? What is a halt? What the hell is it? Okay, it actually happened yesterday, and I'll bring it out for like a split second. Stock market trading halts, they've actually been mainstream headlines since 2020. They actually have. As markets experience extreme volatility with COVID, obviously, and there's extreme volatility during the August of this year when the VIX went to 60, right? It's just an unprecedented amount of magnitude and velocity triggered by what? Algorithms and people not understanding volatility. So traders who weren't around during the 2008 financial crisis are likely experiencing what's called exchange halts for the first time in their lives. And so while seeing quotes freeze across the screen can be unnerving, it's like, I can't trade it. You can't. That's the whole point. Rest assured, these parameters were created as a result of market disruptions in the past. So what's a halt? A trading halt freezes all trading activity for a certain period of time. It's important to distinguish between a market-wide trading halt, a market-wide trading halt in all stocks versus just individual stocks. So for stock market-wide halts, also referred to as trading curbs and market-wide circuit breakers, they call them, this action is meant to buffer volatility, calm down markets, and enable participants to pause, cooler heads will prevail, and take a breather. A market-wide trading halt occurs when the S&P index falls a set percentage below the previous closing price. Individual stock halts are initiated by the specific stock exchange where the stock is listed, and individual stocks can be halted for news, volatility, or regulatory reasons. Now, I'm going to switch gears for a second and let you know, and this was brought to my attention courtesy of one of our back office guys, okay, Nick. It's not a misprint. People are like, this is a misprint. It's not. PGHL, I believe, okay, Primerica Group Holdings. Okay, what you're seeing is not a misprint. It's a misprint. It's the real deal. This was the stock trading yesterday, and I'll put it on a 5-minute extended hours for you to see. During early yesterday, after 15 minutes, this stock was halted. It's a trading halt. It's a freeze. You can't trade it. Cancel all orders. Don't even try. All orders should be canceled immediately. Limits, stops, everything. All options should be canceled. Flat out cancel everything in a basket bundle. Can't trade it. The stock finally opened up at 3:15 p.m. Central Standard Time. I'm not making this up because I was actually watching it, and somebody printed, ask Nick, there was a print of 4,700 shares at 218.99. If that person did not get out, that person is sustaining 5,000 shares times $220, $200. Run that through your head. Go ahead. I'm waiting. See that? That's basically like, what is that? A $2 million loss? Is that what it is? You have to understand, trading curbs are put into place to stop you from trading so you don't do stupid crap. It could be a warning. It could be an irregularity. It could be a CEO died. It means material news is pending that is going to impact the stock. And apparently somebody didn't read the entire memo and realize, yeah, the news is pending. Circuit breaker to the downside, now down 90%. Okay, there's news. Whenever you see a halt, especially a market-wide trading halt, my advice to you is cancel every single trade on the board. Do not be hung open for a market, a limit trade. If it goes off when it reopens, you can't cancel it. You cannot. You cannot leave market opens. Whenever you see a halt, it's for a reason. There's individual stock halts like PGHL, and it's not a misprint, it's the real deal. And there's market-wide halts. The reason why I'm bringing this to your attention is because the way the market's operating, crypto, verticality, 90-degree markets scare the crap out of me. I'm an old fart, people, 36 years. I've seen it all. You're telling me that the market's not going to go down and gap down at some point? No, it will. It'll gap and then bounce because the computers will buy and bounce it. but I don't want to be around for that gap to say that it's halted. And I'm like, but wait a second, I want to buy puts. You can't. If it's halted, no orders or pending orders are canceled. No orders can be entered. You're screwed. Halt means you can't do anything. If you're short and it opens up, you're dead. You're long and it opens down, you're screwed. Can't do anything about it. You can like take it from there. So understand what halts are about. Do not take them lightly. I do believe there will be a halt at some point in the future in the broad market from a very bad down day because the market is just ridiculously overexposed and the VIX is too contained. It can't stay like this forever. It might stay like this for another year, but not forever. I'm waiting for that day to say to myself, whew, I'm sure glad I didn't buy here because if there's a gap down, okay, I can't afford to lose 10, 20% of my net worth in 5 minutes. Can you? All right. I'm going to end this program by just jumping out here. And I know you saw Gianni DePoce come on and do his thing. And you saw Tony Rago do his thing. The sale ends on Black Friday. So you've got today, and technically you've got until Black Friday, which is the 29th, the day after tomorrow. Again, my class, it fills up rather rapidly. I've told you time and again, there's a Genesis Cog Mastermind trade class. If you don't want to take the trade class, that's okay. You can still become a member of the Quant Guy and a member of Theo and request, I want the Genesis Cog watch list and I want the Genesis Cog scanner. We will provide it for you, I promise. But you have to become a member to do this. And to become a member, this can go part and parcel. Here is my Genesis Cog watch list. The gains and the losers are all there. And it even tells you the long, the short, posting, exit entries, it's all there. Plus, you also get the Genesis Cog. Where am I here? I'm sorry. I want to move this out. You get the Genesis Cog scanner so you can track all what I'm watching, all basically 486 stocks and how I rank them and where they might be buys, sells, or holds. You get the Genesis Cog scanner. It goes with the Genesis Cog package. It's worth it. If you spend it now, you'll get $2 for every $1. Why not take advantage? If you do it on Monday, it's too late. Again, you'll get the Mastermind Genesis Cog class, which begins January 15th, 2025, 1 p.m. Central Standard Time, 90 minutes. It's a 12-week course. You can reach out and I'll send you the curriculum. You'll get that. You'll also become a member where you actually get part of in the Genesis Cog scanner, as I just previewed for you. You will also get the Genesis Cog watch list and you'll be able to do anything you want. So if I back this out of the watch list, you'd actually see the full Genesis Cog site, which has got archives, it's got educational videos, it's fully loaded, Herbie fully loaded. Just to give you a little taste of what goes on in the Genesis Cog, here are my last 2 calls. I said, please, please, please to my listeners, please buy Johnson & Johnson. I put out a buy on Johnson & Johnson right over here. Oh, looky right there, 153. Now you're up $3.50. That's what the Genesis Cog does. It gets you in the trade at the optimal time. Lowest risk, highest return on technical breakouts from algorithmic channels. You can see it. There it is, right in front of your eyes. I got in there. It's gone. Archer Daniel Midland put it out last week. Got in over here. There we go. 54, starting to run away. Slow but plodding is okay. People, I'm not about home runs. I'm about singles and doubles. I'm about consistency, low risk, high return. Risk reward ratios for my trades are exceptionally high on breakouts. I do short side, I do long side. I play both. But because of the nature of the market's perma-bullishness and window dressing exercise on that race to the end of the year, most of my calls, like 90%, are long side only. It's okay. I've done well. I did the Wayfair gig. I got in the Wayfair over here, and I got everybody else out right there. That's what I do. I get you in, I get you out. I have a trade service alert. It sends it to your box. It sends it to your phone. You're never behind the times. You will always know when I'm getting in or getting out, and you can search the scanner high and low for any trade you want, even when I'm not around. So it's like having a Jeff Bierman in your back pocket. Isn't that cool? All right. without further ado, again, it's the number is 244 area code, pardon me. 623 area code 244. Okay. 5657. Use the code word Jeff. Okay. I'll do it one more time. That'll be the post turkey day. Get in the Genesis cog. It will change the way you interpret markets. It will get you in that algo groove. In the meantime, it's time for Mr. DePoche to take over from here and run with it. So, hey, Gianni, have a wonderful Thanksgiving, and hopefully maybe you'll be around for Friday for 30 minutes, all right?
Yes, happy Thanksgiving to you too. Thanks.
All right, see ya.